Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's Under the Lens video, I'd like to discuss the potential for a US dollar devaluation. First, let me state up front, I don't believe it is imminent. It is, however, coming and needs to be planned for. It will be significant, it will likely happen at warp speed, and it will have a devastating impact on U.S. consumption, U.S. consumers themselves, and the overall U.S. standard of living. As such, I'd like to cover those items listed here. One of the most common reasons I have seen over the years to accept abnormal market behavior and bubbles is the rationale called TINA. That stands for there is no alternative. In the case of the US dollar, it centers on a few simple and apparent unsolvable problems. The US is the world's reserve currency, and there are no other realistic pretenders to that throne. Yes, there are many issues with what French President Charles de Gaulle originally coined as its exorbitant privilege. The US dollar is felt to be the most liquid, stable, and accepted trade settlement currency out there. The US dollar is seen to have the advantage because it can be held in U.S. treasuries, which traditionally pay high relative interest rates, high credit ratings, and is cost effectively and easily hedged. There are more reasons, but it comes down to why use another currency? Well, those days may be changing. The belief in TINA may cost unprepared investors dearly. The biggest losses always seem to occur when the masses believe something that eventually turns out to simply be a myth. Let's start with how the U.S. dollar is valued. There are many variables that go into the valuation of the dollar relative to other currencies. The simplest way to get an idea of where it might be headed is by analyzing its twin deficit correlation. Over the long term, the US dollar tracks very closely to the summation as a percentage of GDP of the US current account balance and the federal budget balance as a percentage of GDP. Peaks sometimes precede or lag this correlation, but over time regress to the summation. You can't trade this, but it gives you a good approximately 18-month lead time of important moves. The last chart began in 1980 and ended in 2017. This chart begins in 1990 and ends in 2019. You can see the dollar's reaction and reversals in the areas of economic recessions and how it has separated over the last 2 years from the cumulative twin deficits. The separation is prior to the impact of COVID-19, which we'll discuss in a moment, and the U.S. recently entering an overdue cyclical recession. Both are heads up without getting into the impact of COVID-19. At the end of 2019, we were already getting strong indications from the twin deficits that a dollar correction may be soon in the works. With COVID-19, as we will see in a moment, the economics got much worse, but the US dollar was able to hold up well as we witnessed a massive flight to the perceived safety and liquidity of the US dollar. The Fed aided this by the unprecedented move of making US dollar swaps available to almost all global central banks. We have shown this in prior videos. However, we are now seeing dollar weakness as the U.S. tests its long-term trend support. The technical trend line suggests support after a possible 13 to 15% decline sometime out over the next 18 months. However, as I said earlier, the twin deficit correlation is not something to trade on, as well as the fact that trading U.S. dollar is notoriously dangerous. Let's consider both twin deficit elements to see if we can improve our probabilities and possibly timing. The presidency of Donald Trump has not been good for the federal budget deficit. Historic tax relief has caused a major deficit, shown on the right in red. The longer-term trend in the U.S. deficit has been steadily worsening since the dot-com bubble implosion. And now we have COVID-19, which distorts every chart we have seen so far. This is something no other budget has had to contend with in over a decade while experiencing a relatively stable U.S. dollar. Going back to our long-term trend chart, I have overlaid what has happened so far regarding the 2020 fiscal budget. We are already expecting a $1.1 trillion deficit for 2020. Then we had the coronavirus response bill for $2.4 trillion. We'll minimally see a $500 billion revenue shortfall, taking us to a budget deficit somewhere north of $4 trillion. There is another bill in the works in Congress, as well as potential over-expenditures from the 4 separate congressional coronavirus relief bills now in existence. $5 trillion is not out of the realm of possibilities before the fiscal year ends in September. This dramatically worsens our potential devaluation estimates shown earlier. Now let's consider the U.S. current account. It also shows a long-term worsening deficit. It has been relatively good since the 2008 financial crisis, but we need to realize this prompted monetary policies which have been attractive for foreign investors and therefore the need for U.S. dollars to aid the U.S. with its ever-expanding debt payments. We see in the 2 red bars on the right that the first half of 2020 has not been good for the current account deficit. If we revisit our initial dollar support chart, we see the potential for testing the 2011 lows, which would mean an approximately 25% correction. Minimally, it says we are likely to see dollar weakness in the intermediate term. Clearly, this is what the recent surge in gold and silver is signaling. With the dollar now having experienced a golden cross where the 50-day moving average crosses below the 200-day moving average, the probabilities are that the dollar is headed lower sometime before the end of 2020. I can hear the Tina crowd out there saying, yes, this may be the case, but what exactly is the U.S. dollar going to devalue against? If the dollar goes down, something has to go up. The way to consider this is to look at the real effective exchange rate, or the REER, published by the Bank of International Settlement. It shows that 72% of the U.S. dollar movement is about the currency-related shifts in international competitiveness, with the currency shown here. The yuan and the euro account for 40%, with the USMCA partners accounting for another 25%. Here is the US yuan cross, showing the important 7 handle, where the yuan is above or below 7 yuan to the dollar. The yuan has been steadily weakening since 2014 as China's expansion has flooded the world with liquidity. All the developed economies have been active, but it has been China that has the fire hose out. Technically, the chart suggests this may have run its course and it's time for the yuan to regress towards its rising trend regression, which means a strengthening yuan relative to the dollar. This is exactly what we would need for a weakening dollar to occur. The euro chart is also suggesting that some long-term support has been put in over the last year, and though we are likely to see further weakness in 2020, but by late 2020 and 2021, we could see a rising euro relative to the US dollar. This could be even sooner and more aggressive if, in fact, the EU starts to lay out some of its apparent strategy regarding the euro. According to recent circulated papers, European central banks saw a fiat currency failure coming decades ago when the world shifted to pure paper money standard. Accordingly, the European central banks have been carefully preparing a new monetary system based on gold. As the chart shows, the euro area has a much larger gold percentage of its total reserves than most of the world. The EU stands out in this chart, especially when you consider that it is highly likely that the U.S. gold reserves were leased out years ago and only exist on paper and cannot be physically produced other than in the form of credit from gold bullion banks. The charts for the USMCA members of Mexico and Canada are also constructive for potential cross-currency strength. There is no guarantee of any of this occurring, but when we consider the twin deficits and these cross-currency pressures, our probability of a U.S. devaluation out over the next 18 months to 2 years goes up dramatically. The U.S. dollar is slowly losing its hegemony as the global reserve currency. Eventually, this will cause a sea change for the U.S. economy and the U.S. standard of living. The U.S. now has another deficit, and that is it has the largest trade deficit in the world, but fortunately, it still has the dominant reserve currency. The U.S. dollar, being the largest reserve currency and the largest international funding currency, permits the U.S. to easily fund its massive and steadily growing trade deficit. Let's look at the pressures that have been underway for a while now on foreign exchange reserve holdings. Overall, global reserve currency holdings have been more or less flat since around 2014 when the monetary policy of quantitative easing was launched by the U.S. One reason was because global trade had stalled since the 2008 financial crisis and more dollars in global circulation were required. Slowing global exports versus output reduced the need to increase reserves, while we witnessed a 5% decline from 66 to just over 61% of the global currency reserves being held in U.S. dollars. This average decline of about 1% per year is significant, but as yet has not fully impacted the U.S. dollar. The decline has likely not impacted the U.S. dollar because the numbers are still so large and liquidity is paramount in a highly leveraged world, as demonstrated during the COVID-19 market decline when the world scrambled for the Fed to provide unprecedented U.S. dollar swaps. The trend is now accelerating and consistent, as shown here on the right side of the pie chart in blue. From 1971 to 2018, the U.S. share of global GDP shrank dramatically. During this same period, the U.S. share of global reserves shrank 24% from just over 85 to 61%. This is about 0.5% on average per year as compared to the current average now at 1% over the last 5 years. The accelerating erosion will only be worsened by the U.S. trade deficit increasing relative to potential continued slowing global trade. In recent years, many G20 members such as China, France, Germany, and Russia have reduced their utilization of the U.S. dollars in trade deals, thereby reducing the U.S. dollars they require. From the perspective of the U.S. debt, 22 consecutive months from April 2018 to March 2020 saw global central banks reducing their overall U.S. debt holdings. In last year's de-dollarization thesis paper, we outlined the pressures on the U.S. dollar from the U.S. policies fundamentally weaponizing the dollar as part of its foreign policy. We spelled out how a long and growing list of countries is aggressively reacting to U.S. broadening use of economic sanctions. This includes both countries directly targeted by U.S. policies and countries trading with those affected countries. The scope of U.S. sanctions, as we point out in the thesis paper, which is available at the MATA SII site, has become so large that it is literally forcing countries to minimize U.S. dollar dependence or become subservient to U.S. foreign policies. According to information disclosed by the Society for Worldwide Interbank Financial Telecommunications, that is the SWIFT system, in May, the share of U.S. dollars in the international payment market was 40.8%, a drop from 44.1% in March. Meanwhile, many countries' central banks have increased their gold reserves, and the year 2019 marked the 10th consecutive year of annual net purchases of gold. This is no longer a unipolar world with the U.S. as a central power. We are now in a multipolar world where the U.S. no longer has the economic clout to dictate policy, and the U.S. dollar is more and more seen simply as a club. I believe what is currently holding the dollar up is the central role the Federal Reserve is still playing as part of former Fed Chairman Ben Bernanke's Enrich Thy Neighbor doctrine. The essence of this doctrine is that if all countries expand their money supply in a coordinated fashion, then there is no place to flee to, and few can see the debasement erosion of the involved fiat currencies. Of course, this only works if gold is manipulated in controlled fashion. This is exactly why the market now has diverged from historic fundamentals and actually trades completely in alignment with the global liquidity proxy. If you needed further proof, you saw how the markets immediately reacted after the COVID-19 market plunge. Bernanke believed that the growth rate of credit, as big as it was no longer sufficient, and that we needed an increased wealth effect in addition to foster funding of economic growth. When you debase currencies, it will show up in land prices, real estate, stocks, and hard assets. All are constructive in regard to the wealth effect, except for hard assets, such as gold, which is destabilizing to the doctrine and must be continued to be controlled. The question is, what happens when they all are too high? Like trees growing to the sky, we know something, often unpredictable, will always eventually destabilize them. I think we're already well on that road to destabilization, a road that will lead to forced devaluation of the U.S. dollar and likely even a political policy of devaluation of the currency by the U.S. as it attempts to devalue the currency for competitive trade advantage. The Trump administration is already pressuring the Fed and Treasury for this in a desperate attempt to promote economic growth. The administration needs to be reminded that no country has ever succeeded in devaluing itself to prosperity. However, expedience is a tool often used by the political apparatus. In prior videos, I have outlined various roadmaps we are on. They all point toward a fiat currency crisis as an eventuality. We are locked into that eventuality. We just don't know how long it will take. The good news is we have lots of signposts to tell us where we are on that roadway. There are many implications of a weak U.S. dollar. We need to start now to prepare for them. Many of them we have already laid out as investment ideas and actions in our 3 current focus themes on the MATA SII website. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. I thank you sincerely for listening.